If you're thinking about investing in DeFi, don't. Not just yet, because there's something crucial you need to know before you make a single move. Most people see DeFi as just another way to dabble in crypto. But using the common strategies most investors use, you're setting yourself up to fail before you even start. You see, DeFi isn't just some extension of the crypto world. It's a revolutionary financial system that can either build your wealth beyond what you thought possible or drain your assets faster than any stock market crash. And the crazy part, most investors are making some dangerous mistakes over and over. In the next few minutes, I'll reveal the biggest traps that new DeFi investors fall into, plus exactly how to avoid them. I'll also show you 4 powerful strategies that can help you harness DeFi's full potential, with one strategy standing out above the rest. It's the strategy that smart investors are quietly using to secure their nest egg and set their financial future up. It's a strategy you can use too. So stick around to find out which one it is and why ignoring it could cost you thousands. By the end of this video, you'll know exactly what you need to do before investing into DeFi and how to protect yourself from the pitfalls that have tripped up so many others. Sounds good? Let's get into it. What is DeFi? Well, decentralized finance, or DeFi, is a new frontier in finance. It's like taking the entire traditional financial system, removing the middlemen, and giving you the power to control your own assets. No banks, no brokers, just you and the market. But here's where it gets interesting. DeFi isn't just about cutting out the middleman. It's about unlocking opportunities most investors have never ever heard of before. Yet, without a clear path, diving into DeFi can feel like swimming with the sharks. So, let me hand you 4 must-know strategies that can make or break your DeFi experience. First up, yield farming. Yield farming is the process of depositing your crypto into a liquidity pool to earn rewards, like fees and bonus tokens. It's kind of like listing your property on Airbnb. Your space, or in this case, your crypto, is always being used, generating income while you do nothing. Platforms like Uniswap and SushiSwap offer yield farming opportunities where you can earn anywhere from 10 to 50% APY on popular pairs. And for more niche tokens, the returns can go up to as high as 200 or even 300%. Sounds great, right? But be careful, higher returns always come with higher risks. And the expected returns? They can be pretty high, honestly. You're looking at anywhere from 10% APY on the low end all the way up to 300% if you're going for those smaller, riskier tokens. This is all based on historical data. But here's what you need to know. The pros are, you get high earning potential, especially with newer or emerging tokens. And you can achieve a passive income without having to sell your crypto. Now here are the cons. Something we call impermanent loss. If the price of your deposited tokens changes significantly, your profits can disappear very fast. And of course, if there's a bug or a hack in the system, you could lose everything. My tip: avoid obscure, unverified projects. Stick to platforms like Aave, Curve, or PancakeSwap. They're known for being secure and reliable. Next, let's talk about staking, a simpler way to earn passive income through DeFi. Staking is basically locking up your crypto to support the operations of a blockchain network, and in return, you earn rewards, often in the form of more tokens. It's like putting your money in a high-yield savings account. Your funds grow, but you can't touch them until the term is up. And the expected returns? Well, they're pretty solid. Usually you can earn anywhere from 5 to 20% APY, depending on the network. Ethereum 2.0 and Cardano offer around 5% to 10%, while projects like Polkadot or Solana may give you up to 20%. Here's a quick rundown on the pros and cons. The pros are lower risk compared to yield farming, regular, predictable income through staking rewards. The cons, on the other hand, your funds are locked up for a set period, usually ranging from weeks to even months. Plus, if the network validators mess up, you could lose some of your staked funds. For beginners, platforms like Coinbase and Kraken make it easy to get started without diving too deep into the technical side of things. Next up, we've got another powerful investment strategy that most investors overlook: DeFi indexes. A DeFi index is like a basket of different DeFi tokens bundled together so you can invest in a range of assets all at the same time. Think of it like a mutual fund, but for DeFi projects. For example, the DeFi Pulse Index, or DPI, includes a collection of top-performing DeFi tokens like Maker, Compound, and Synthetics. Or there's Index Coops, Metaverse Index, which gives you an exposure to DeFi-related tokens in the metaverse space. And the expected returns? Well, these can range from 8% to 25% annual growth based on past performance. Not bad, right? So what are the pros of these indexes? First off, you have instant diversification. You're not putting all your eggs in one basket. Secondly, there's less active management needed. You just invest and let it grow. What are the cons? Well, if one token in the index crashes, it affects the entire index. Also, some management fees can cut into your returns. If you're looking for a safer way to dip your toes into DeFi, an index like DPI or MVI could be a good start. Next up is lending and borrowing. In DeFi, you can lend out your crypto and earn interest, like putting your money into a savings account, but with potentially much higher returns. Platforms like Aave and Compound are the big names here. And the expected returns? Well, pretty high, honestly. You're looking at 3% to 15% APY, depending on what you're lending, and it's much better than you would ever get from a traditional bank. Or if you need some cash, but don't want to sell your crypto, you can use it as collateral to borrow funds. Just be careful. If the market dips and your collateral value drops, your assets could be liquidated in seconds. However, there are a couple disadvantages that could wreck your portfolio. So here's what you need to know. The pros are passive income from lending stablecoins or crypto, access to liquidity without having to sell your holdings. The disadvantages, however, sharp market movements can lead to your collateral being liquidated. Interest rates can change rapidly based on supply and demand. My advice: use platforms with strong over-collateralized requirements and keep an eye on your collateral ratio. Next up, real-world asset tokenization. DeFi isn't just about digital coins anymore. Now you can invest in real-world assets like real estate, art, or even precious metals, all represented by digital tokens. Here's how it works. These tokens are backed by tangible assets, giving you a share of their value. For example, you can own a fraction of a rental property on platforms like Realty and earn rental income as the property generates it. Or you can invest in tokenized gold through platforms like Paxos, where each token represents a specific amount of physical gold stored securely. And the expected returns? Well, for something like rental income, you're looking at 5 to 12% annual yield. For assets like gold, well, the returns are lower, more like 1 to 3%, but it's a safe hedge against inflation. Here are the pros of this strategy: exposure to traditional assets without the usual hassle, less volatility compared to regular crypto assets. Here are some cons. Liquidity can be an issue. Selling these tokens can take time. Regulations are still evolving, so it's a bit of a gray area. If you're new to this, start with a well-known platform like Realty or Paxos. They've got a solid track record and are known for their transparency and security. These strategies can offer great returns, but they're not without risks. Always remember to diversify and start small. Now, before you go all in on DeFi, let's talk about something most people overlook: risk management. One wrong move can wipe out your investment in seconds. So, how do you protect yourself? First, diversify. This is simple but crucial advice. Spread your investments across different protocols. Don't put everything into one basket. You wouldn't do that with your retirement fund, right? Second, start small. Start small and test the waters before diving in. Begin with a smaller investment to see how things work, whether it's providing liquidity, staking, or lending. This way, you can get a feel for the process without risking too much. For example, try allocating a small amount into a stablecoin pool to understand how yield farming works. Or stake a minimal amount on a platform and watch how the rewards accumulate. This cautious approach makes you learn the ropes and adjust without the stress of a large commitment. Remember, it's easier to scale up once you're confident and comfortable than to pull back after going in too deep. Third, stay informed. Always keep up with the latest news and updates about platforms you're investing in. Look for smart contract audits from reputable firms. These audits are like security checks for the code that runs DeFi platforms. They help identify any bugs or vulnerabilities before they become a problem. If a platform has been audited, it's generally safer, but you should still keep an eye on any updates or changes that they make. For example, follow DeFi forums or join community chats to stay updated. If there's news about a security issue or major update, you'll want to know right away so you can adjust your investments if needed. It's also a good idea to subscribe to newsletters or alerts from the platforms you're using. This way, you'll be notified directly if anything changes that could impact your funds. Remember, the DeFi space moves fast. Staying informed can help you avoid unexpected losses. Now that we've covered that, I'm sure you know that DeFi is more than just another investment opportunity. It's a groundbreaking shift in the way we handle money. Otherwise, why would you be watching this video right now? But with this opportunity comes risk, more risk than most people realize. If you want to succeed, you need to be armed with the right knowledge and a clear strategy. Use everything we've covered today and you should be good. Now, if you're ready to dive in a bit deeper and you want a 3-step DeFi investment strategy handed to you that's been responsible for turning a $57,000 nest egg into a $1.87 million nest egg, we've got a free guide that gives you exactly that. We cover everything from the basics to the advanced strategies that can help you navigate this landscape like a pro. Just click on the link in the description to access it. Remember, in the world of DeFi, knowledge is your best investment. So start learning, start exploring, and get ready to take control of your financial future. So until next time, my friends, take care.